Hello everyone. As you're all hopefully aware, the personal tax year is almost over, so I thought it'd be really useful to send a quick video with a few considerations just in case they've slipped your mind. In case you've forgotten, or if this is the first tax year that you've been self-employed or had to do a self-assessment tax return, the personal tax year ends on the 5th of April 2021, and the subsequent deadline for that tax return is going to be the 31st of January 2022. If you're a client of ours, we're going to send you a checklist as we usually do in early April, and so there's nothing you need to do. We'll reach out to you. If you're not a client and you're not sure whether or not you need to submit a tax return, reply to the email that this comes through on and one of the team will help you out. And as a reminder, the tax year always goes from the 6th of April to the 5th of April. So this year's tax year went from the 6th of April 2020 to the 5th of April 2021. And the key thing that you need to be aware of is that certain allowances will reset at the end of the year. And if you don't use them, you lose them. So make sure you pay attention and don't lose out on any sort of tax tips. The very first thing I want to talk about is your ISA allowance. Now in total you get £20,000 a year to go towards your ISAs. There are two types of ISA. You've got your lifetime ISA, which has an annual allowance of £4,000, and that ISA is one that you can only start or open if you're under 40 years old, I believe, and there are some drawbacks to it, which I'll go over in a moment. But the key thing is you've got an annual allowance of £4,000, so if you've not used that yet, it's really important that you make sure you use it before the end of this tax year. And the other more regular ISA, so you've got your cash ISAs and your stocks and shares ISAs, those are regular ISAs. You've got up to £20,000 a year in allowances that you can use there. And one thing you need to be aware of is that the £20,000 allowance is your total ISA allowance. So if you've got a LISA and a stocks and shares ISA, then you can only contribute £4,000 to your LISA in total and £16,000 then in total to the other ISA. So that's the ideal mix, but if you happen to only contribute £1,000 in one into the LISA, then you can put £19,000 in the ISA. You can usually only open one ISA product a year, so and the LISA itself needs to be reopened every year, even if it's the same account. I'm not sure why they do that, but so if you haven't got a regular ISA, my advice would be, first of all, this year, open a regular ISA, and to clarify, this is if you're going to be putting the maximum in. So first of all, I'd open a regular ISA because that doesn't need to be reopened every year, and then subsequently open a LISA every single year. All gains in that, capital gains and dividends, are tax-free. So let's say you bought Tesla shares and you managed to get them in your ISA, all those gains this year, if you then sold them, would be tax-free. Equally, if you've got shares that pay out dividends, Legal & General, Lloyds, the dividends will be tax-free. So and dividend yields are usually better than interest that you get in the bank. Obviously, the value of investments can go up as well as down. I'm not an independent financial advisor, so I can't advise on that. However, please be aware that the gains in there would be tax-free. And one of the benefits of using a LISA, and the reason that I would say to prioritize that ahead of the ahead of the stocks and shares ISA, is that the government contribute 25% to it. So if you put the full £4,000 into a LISA, the government will give you £1,000 of cash in that LISA. So the overall return instantly is 25%. The drawbacks to using a LISA are that if you withdraw the money before you retire at 55, which is the earliest that you're allowed to retire and withdraw the funds, if you try and withdraw them earlier, there's a charge. So please only put money in a LISA if you're definitely not going to touch it for a few years. You can withdraw money from a LISA if you're purchasing your first property with a mortgage. In general, you've got to see it as a long-term investment. It's really worth it if that's the case. Those are the drawbacks. The second thing to talk about are SIPPs, which are self-invested pension plans, and you can contribute up to £40,000 a year into SIPPs. You have a lifetime allowance of around £1 million. It's like £1,050,000 something currently, and the main benefit to this is that the money in the SIPP, similar to an ISA or a LISA, can make gains that are tax-free. I'm not going to go too much into the actual personal pension kind of tax implications. The most important thing and the best kind of tax break that people, especially our clients, can get is from their limited companies, and that's because your employer's contributions are tax deductible for corporation tax. So if you've got a limited company and you pay £40,000 into your SIPP, that £40,000 is a tax deductible business expense. So your corporation tax, which is currently 19%, will be reduced by £40,000, 19% of £40,000. So it's a really useful way to extract money from the company. Again, the drawback is you're not going to be able to touch it or benefit from it until retirement, but long-term thinking is good in the long run. If you haven't set one up, or you might be thinking, well, I don't plan on contributing anything this year or in the next year or so, one thing to bear in mind is that you can carry forward your allowance, your unused allowance with pensions for up to 3 years. So, and that's most allowances, you can't do that. The only way you can carry it forward is if you have started the pension. So my advice to you would be, if you haven't already set up a SIPP, set one up and make the minimum contribution, £100, and then that means you've kind of got that full £40,000 allowance that you can carry forward to next year. You can do the same next year and the same the year after that, and then you'll have £120,000 worth of allowance, which you may or not be in the position to use, but it's much better to be in that position and realise you can use it than to have £120,000 sitting there and not be able to use it or utilise it. So definitely open a SIPP if you can. The next thing to talk about are capital gains allowances. So similar to personal tax, income tax, you have a tax-free allowance of £12,500. You also have a capital gains allowance of £12,300. So you can make £12,300 worth of capital gains tax-free every single year. Capital gains are made when you sell stocks and shares or other assets, for example, cryptocurrency. And we all know that cryptocurrency is kind of gone a bit crazy this year. So if you are sitting on a large number of cryptocurrency tokens, you might want to consider at least selling enough to make a gain of £12,300 so that you get a gain 0%. Also, another thing to bear in mind is that capital gains tax rates are much more favourable than income tax rates. So the gains are after the £12,300, they are 10% if you're a basic rate taxpayer and 20% if you're a higher rate taxpayer. Now, currently there's a lot of, the budget is coming up and there's a lot of speculation that Rishi Sunak is going to kind of introduce major changes to several different taxes, capital gains one of them. So if you're sitting on a huge gain, I don't really want to speculate, but there's a high chance, I think, that taxes are going to definitely go up somewhere. You might want to consider crystallising those gains in this current tax year before the changes come in, or at least wait and see what the changes are, I suppose. Before if they change them, if they match income tax rates, which are 20%, 40% and 45%, your capital gain, the tax on it will double potentially next year. Unused allowances aren't carried forward, so make sure you use them. If you've got a spouse who has unused allowances, so if you use yours, or if you've got stocks and shares sitting there and you're a higher rate or an additional rate taxpayer, consider gifting the shares to your spouse, because a transfer between spouses won't trigger any tax. Your spouse could then sell them and you could benefit from their tax allowances. So that's one thing there to think about. I hope that was useful. If anybody's got any questions, please send them through. You can send them to myself directly, or send them through, reply to the email that this came on, and one of the team will help. Thanks a lot.